Here's something I've noticed about investing in conversations. The more you learn, the more complicated it seems to get. You start with one fund, then someone mentions factor investing, then someone else brings up sector rotation. Then you're reading about small cap value premiums at midnight, wondering if you've been doing this completely wrong. And somewhere in that process, the actual goal, building real lasting wealth, gets buried under a mountain of noise. I've spent a lot of time thinking about what a genuinely useful long-term portfolio looks like. Not optimal in some theoretical sense, useful, the kind you can actually stick with through a market crash, a job change, a recession, and still come out ahead decades later. What I landed on was 5 ETFs. That's it. In this video, I'm going to walk you through exactly which 5 ETFs I use, what role each one plays, and how to think about splitting them based on your own situation. This isn't about finding the highest returning fund of the past 3 years. It's about building a portfolio that gives you real global exposure, stays low maintenance, and compounds quietly in the background while you get on with your life. No stock picking, no market timing, no complexity for its own sake. Just a clear system explained plainly. The 5 ETFs. Let's walk through each one. ETF number 1, the Core, S&P 500 Index Fund. The S&P 500 is the backbone of this portfolio, and there's a good reason it comes up in almost every investing discussion. It tracks the 500 largest publicly traded companies in the US, companies like Apple, Microsoft, Amazon, Nvidia. Broadly speaking, it's a representation of the US economy's most dominant businesses. For US investors, the 2 most popular low-cost options are the Vanguard S&P 500 ETF, ticker VOO, and the iShares Core S&P 500 ETF, ticker IVV. Both carry expense ratios of just 0.03% annually. That's $3 for every $10,000 invested per year, essentially free. Historically, the S&P 500 has returned roughly 10% annually over very long periods, going back to the index's inception in 1957, or about 7% after inflation. The past decade has looked significantly better than that, but long-term planning tends to use the more conservative historical baseline. In this portfolio, I hold the S&P 500 at 40%. It's the engine. ETF number 2, Global Diversification, International Developed Markets. The second ETF adds what the S&P 500 doesn't, covering the rest of the developed world. We're talking about Western Europe, Japan, Canada, Australia, and similar economies. These are mature, stable markets with established regulatory frameworks and long operating histories. My preferred option here is the Vanguard FTSE Developed Markets ETF, ticker VEA. It holds nearly 4,000 stocks across developed markets, including Canada, with an expense ratio of just 0.03%, one of the lowest available for this category. The iShares Core MSCI EAFE, ticker IEFA, is another solid choice, covering Europe, Australasia, and the Far East, though it excludes Canada and carries a slightly higher expense ratio of 0.07%. Adding this doesn't just reduce concentration risk, it also gives you exposure to industries and companies underrepresented in US markets. European consumer staples, Japanese industrials, healthcare companies across different regulatory environments. I hold international developed markets at 25%. It's the portfolio's geographic counterweight. ETF number 3, the Growth Card, Emerging Markets. This is where the portfolio gets a little more interesting. Emerging markets ETFs cover economies like India, China, Brazil, Taiwan, South Korea, and others. These are countries growing faster than developed economies, in some cases significantly so. And over long time horizons, that growth potential shows up in equity returns. 2 strong options here are the Vanguard FTSE Emerging Markets ETF, ticker VWO, at an expense ratio of 0.06%, and the iShares Core MSCI Emerging Markets ETF, ticker IEMG, at 0.09%. One meaningful difference between them: IEMG includes South Korea, while VWO does not, because FTSE classifies South Korea as a developed market. Given South Korea's role in global semiconductor and AI supply chains, that distinction has mattered in recent years. Worth knowing before you choose. I want to be clear about the trade-off here. Emerging markets are volatile. Not just they go down a bit more volatile. In bad years, they can fall 30, 40, even 50%. Political risk, currency risk, regulatory risk, these are real factors that don't apply the same way to US or developed market funds. That's why how much you hold here should depend directly on your time horizon and your honest tolerance for discomfort. If you're investing with a 20+ year horizon and you can sit through the swings, emerging markets can contribute meaningfully to long-term growth. If you're closer to retirement or you know from experience that big drawdowns make you want to sell, consider reducing this allocation or removing it entirely, shifting instead toward developed markets. I hold emerging markets at 15%. It's the growth accelerant, not the foundation. ETF number 4, the stabilizer, US aggregate bonds. Here's where a lot of investors check out. Bonds aren't exciting. In a bull market, they look like dead weight. And in 2022, when interest rates rose sharply, bond funds actually lost money, which frustrated people who held them specifically for safety. But here's what bonds are actually doing in this portfolio. They're not there to generate maximum returns. They're there to behave differently from stocks. Historically, when equity markets fall sharply, high-quality bonds often hold their value or rise, providing a floor and giving you the psychological buffer to stay invested in your equities rather than panic selling at the bottom. A strong, simple option here is the Vanguard Total Bond Market ETF, ticker BND, or the iShares Core US Aggregate Bond ETF, ticker AGG. Both offer broad exposure to U.S. investment-grade bonds, treasuries, mortgage-backed securities, corporate bonds, and both carry an expense ratio of just 0.03%. One note on bond ETFs, you'll typically find two share classes: distributing, which pays out interest as income, and accumulating, which reinvests automatically. For long-term growth, automatic reinvestment tends to be the simpler choice. If you're in or near retirement and you need that income flowing to you, distributing makes more sense. I hold bonds at 10%, not dominant, but genuinely useful when markets turn rough. ETF number 5, the hedge, gold. The fifth position is the one that generates the most questions, gold. Let me be direct about what gold actually does and doesn't do in a portfolio. Gold doesn't pay dividends. It doesn't grow earnings. It's not a productive asset in the way a business is, and its relationship with market stress is not as clean as the headline often suggests. In 2008, gold actually fell about 28% through the initial shock of the crisis as investors sold everything to raise cash. But here's the nuance. By year-end 2008, gold finished roughly flat for the year, and from its October 2008 trough, it surged nearly 163% over the following 3 years, as central banks flooded the system with new money. So the protection came, just not in the first few weeks of the panic. In 2020, gold sold off briefly alongside equities in the March crash, then recovered within weeks. By August 2020, it had hit a then-record high above $2,000 an ounce, gaining roughly 25% for the full year while equities were still recovering. The honest takeaway? Gold is not a perfect crisis hedge in the immediate term, but over the broader arc of market turmoil, it tends to provide meaningful diversification that's largely uncorrelated with both stocks and bonds. For cost-conscious long-term investors, the SPDR Gold Mini Shares, ticker GLDM, carries the lowest expense ratio of any major physically backed gold ETF at 0.10%. The iShares Gold Trust, ticker IAU, is another well-established option at 0.25%. Both hold physical gold in vaults and track the spot price directly. One tax note worth flagging: gold ETFs like GLDM and IAU are structured as grantor trusts and are taxed as collectibles at rates up to 28% on long-term gains, higher than standard capital gains rates. Holding them inside a tax-advantaged account like a 401k or IRA where possible helps sidestep that issue. I hold gold at 10%. It's not the strategy, it's insurance. So, the full breakdown looks like this: 40% VOO, S&P 500, 0.03% expense ratio; 25% VEA, International Developed Markets, 0.03% expense ratio; 15% VWO, Emerging Markets, 0.06% expense ratio; 10% BND or AGG,
U.S. aggregate bonds, 0.03% expense ratio. 10% GLDM, gold, 0.10% expense ratio. 5 funds. U.S. and global equity exposure, stabilization from bonds and gold, and meaningful diversification across developed and emerging economies. The blended expense ratio across the full portfolio works out to roughly 0.04% per year, about $4 for every $10,000 invested. That's a remarkably low annual cost for what is a genuinely global, multi-asset portfolio.
A few practical things to think about before you build your own version of this. Step 1. Match the allocation to your timeline. If retirement is more than 15 years away, you can tolerate more equity volatility. If it's closer, shift weight toward bonds and trim the emerging markets allocation. Step 2. Find the right tickers for your account. The funds mentioned here are widely available in U.S. brokerage and retirement accounts, but check your 401k's fund lineup. Many plans offer equivalent index funds even if they don't list these exact ETFs. Step 3. Decide on accumulating versus distributing. In growth mode, automatic dividend reinvestment keeps things simpler. If you're drawing income in retirement, distributing share classes make more sense. Step 4. Hold gold in a tax-advantaged account where possible. Because gold ETFs are taxed as collectibles, a 401k or IRA shields those gains from the higher collectible rate. Step 5. Rebalance once a year, not more. When any allocation drifts more than 5 to 10% from its target, rebalance back. That's it. This portfolio is designed to run without constant attention. Step 6. Test your tolerance with a backtesting tool. Several free platforms let you model how different allocations behaved through past market crashes. Seeing an actual drawdown number, not just a percentage, but a real dollar figure on a real account, is far more informative than reading about volatility in the abstract. The thing that often gets lost in investing conversations is what the actual goal is. It's not maximizing returns in any given year. It's not owning the most talked about fund. It's building a portfolio that grows quietly in the background, weathers the inevitable bad periods without requiring heroics, and eventually gives you real financial options, the ability to retire when you want, to take risks in your career, to stop feeling financially